Thank you, Ed. The topic I'm going to talk about is productivity and growth of potential output in the United States. In daily discussions about the economy, these words, these topics don't get a lot of play, but arguably they're the most important thing for us to be talking about. And the reason is given by this famous quote by Paul Krugman, which is that productivity isn't everything, but in the long run, it's almost everything. A country's ability to improve its standard of living over time depends almost entirely on its ability to raise its output per worker. So that truth gets lost in the day-to-day noise about what we normally talk about. You know, how much is the Fed going to buy of mortgage-backed securities at this next meeting, or what's going to be the latest wiggle in the data, or the latest on the sequester. But over long periods of time, those things tend not to be very important, and they wash out, and what really is left is a longer-term trend in how fast we can increase the amount that we produce per worker in the United States. And if you look back over a long historical perspective, this really becomes clear. So we have reasonably consistent data on output per hour in the United States to go back to 1889. Not perfect by any means, but reasonably consistent. And what they show is that real output per hour in the U.S. has risen about 2.25% per year on average. So if you start accumulating those 2.25% year after year, you get a doubling after 31 years. And over the entire span since 1889, you get a 15-fold increase. So real output per hour today is 15 times higher than it was 123 years ago. That's what's generating the improvement in living standards generation after generation. So within that long historical sweep, what I've put up in this slide are the last 40 years of output per hour in the United States for the non-farm business sector, which is the sector of the economy that economists generally look at when they study productivity trends. And I've broken it up into three regimes. The first regime in the green runs from the early 70s until 1995. That was a regime of relatively slow productivity growth. The average rate of increase was about 1.5% per year, so well below that long-term historical average. The middle regime in red was a fast growth period that ran from about 1995 to 2004. During that period, productivity growth averaged 3% per year, so double what it had in the previous regime. And then the last regime shown in black is the one we're in right now, which has been prevailing since 2004. And that, again, is a reversion back to a slow regime, again, about at 1.5% growth. So this just lays out the general patterns. What I'm going to do next is to talk about a framework for understanding what's driving these changes. So economists who look at these issues use a standard technique called growth accounting, which tries to relate through an economic model the observed growth in output per hour to three key general explanations. The first is focusing on changes in the composition of the workforce. So an hour worked is not a homogeneous thing. Some people are better educated, they have more job experience, they are more skills, and so what they produce with a given hour is more than someone else. So we have to pay attention to the mix of the labor force. The second is that over time, the economy accumulates more capital per worker to use. So better tools and more tools, and to the extent that that happens, output per hour tends to rise. This is called capital deepening. The third is the ability to produce more output with a given amount of capital and labor. This is called multi-factor productivity, or MFP for short. I'll use MFP a lot in the talk. So this is a big basket that includes anything that can raise output without requiring more capital and labor. So it can be improved management of a firm to make sure that the firm is getting the most it can out of its resources. It can be scientific advances that improve technology. It can be new business practices that allow firms to be more efficient. So it's a big grab bag of things, but as you'll see, it's important. So let me give a couple examples of capital deepening and MFP just to make it a little more concrete. So if I have a PC, an old one, and I replace it with a new one, that is a form of capital deepening because I now have a better tool to use to do my work. On the other hand, if I have my old PC, don't replace it, but then I have access to the internet, so I can find information much more efficiently than I could before with the same old computer, that's MFP. And another example would be in the semiconductor industry, the massive improvements in semiconductor technology that allow greater and greater computing power on smaller and smaller chips because of scientific advances. That's also MFP. So now let's put some numbers on these general concepts. So I have a table here that has the three-way breakdown into labor composition, capital deepening, and MFP, but additionally shows detail on the role of information technology within the capital deepening category and within the MFP category. And when I say IT capital deepening, what I mean is the increasing amount of computer hardware, software, and communication equipment that are available to be used by workers in the U.S. economy. And when I talk about MFP in the IT producing sector, what I mean are the efficiency improvements in the industries that produce IT goods. So in computer hardware production, software production, communications equipment production, and the semiconductor sector, which I lump with these because that really is the engine for all the growth that those other sectors generate. So what you can see if you look at the first two columns is the speed up in productivity growth that I mentioned that started around 1995. And by looking in the blue shaded rows, you can see that this analysis attributes a substantial part of that speed up to information technology, both capital deepening because of more hardware and software per worker, and also because of rapid efficiency improvements in the industries that produce those goods. And in addition, there was a very large jump in the MFP growth for the economy outside of the IT producing sector, which I think is related to what was happening in IT. So here's a story that I would tell for what lies behind these numbers. In the mid-90s, we embarked on a period of really extraordinary improvement in semiconductor technology. Product cycles got much shorter. There were very rapid declines in the prices, quality-adjusted prices of computers, communications equipment, anything that uses semiconductors. That caused businesses to buy a lot of this stuff. We really had an investment boom. Equally important, we had the rollout of the internet as a tool for commerce and business, which radically changed the way business is done. It made information much more readily available, and it made it possible to share information. So all that computing technology became much more useful than when it was primarily employed on a standalone basis. So it was a combination of connectivity with greater power, which generated the fast growth from IT capital deepening and the MFP in the IT producing sector. But as businesses were using all of that new technology and using the internet, they discovered that they could do business differently and more efficiently. That's what generated the rapid MFP growth in the rest of the economy. So an example would be online retailing. Just think about your shopping habits before the mid-90s and think about them now. It is very different. It's more efficient. Amazon and other online retailers have a large share of the market. That was really enabled by the information technology, and that was the MFP that occurred outside of the IT producing sector. Let me go back. So now, from the period of rapid growth, we're now back into the slower growth regime. And essentially what happened is that a lot of what happened in the mid-90s reversed. So we don't have extraordinary declines these days in IT prices. Rapid, but just historically normal. Many of the internet applications that were adopted, the most useful ones were adopted early on, and we're now into somewhat more marginal things. And third, and equally important, the IT producing sector of our economy is shrinking rapidly. And that is a big problem. So this chart illustrates that point. So the blue line shows the share of total non-farm business output in the United States that is represented by the production of computers, communication equipment, and semiconductors. As you can see, it peaked in around 2000, and it's been a steep slide since then. And what this reflects is that most of that production has been offshored. It's now in Asia, and it's now in Latin America, and it's in countries in Europe. And it's probably not coming back anytime soon, even though there's a little dribble of some of that production that is making its way back to the U.S. This is a problem because these sectors are the most efficient and most rapidly growing sectors in the U.S. economy. So when they become a smaller share of our total economy, we end up having less productivity growth. So this is another reason that the last 7 or 8 years have been a slower growth period. So all of that is analysis of the past. Now let's look ahead and ask, what are the prospects for productivity growth going forward? So this table shows forecasts from 4 different sources: the Congressional Budget Office, the Survey of Professional Forecasters, which aggregates roughly 30 forecasts from the private sector and from academic economists, Robert Gordon from Northwestern University, who's a prominent commentator on productivity issues, and forecasts that I've done with my colleague Dan Sickle and a variety of others. We're showing forecasts at 2 different points in time: 2007, just on the edge before we hit the recession and the financial crisis, and today. So what you can see is that in 2007, the forecasts were very tightly clustered at about 2 to 2.25%, basically the long historical average. And since then, they've all been revised down by varying amounts, but the average of the forecast now is below 2%, which is subpar by historical standards. And what happened, I think, basically is that between 2007 and today, there was an accumulation of information coming out about the economy that said productivity growth had remained weak, and forecasts got updated, not surprisingly, to reflect that new information. So that's where we are today, a little below 2%, with the Congressional Budget Office a little more optimistic than the others, but also still below the long-term historical average. Now, before I leave this slide, I just have to say that these forecasts are informed opinion, but they're almost certainly going to be wrong, because productivity forecasts almost always are wrong. I've been doing this for a long time, and it's just very hard to predict breaks in trend, technological developments that will come along that can change radically how the economy operates. So it is possible, I think, to imagine a brighter future that is embodied in these numbers. And it could be related to IT in terms of a second wave of productivity improvement that would be related to the combination of the use of handheld devices, tablets, smartphones, linked to massive databases in the cloud, really using big data combined with mobility. And we're beginning to see some of this in the U.S. economy, but it still isn't widespread enough to make an imprint on the data. But 5 years from now, who knows? So let me now transition to the last topic of my talk, and that is to broaden the focus from productivity growth, which is the growth in output per hour, to the growth in the economy as a whole. So to bring in the other factors, primarily the growth of hours that are necessary to move from productivity growth to how big the pie, how fast the pie as a whole can grow. So when I say potential GDP, I'm using the standard economist definition, which is an economic, not an engineering concept. And it defines potential GDP as the maximum level of real GDP that could be produced with a stable rate of inflation. It's not an engineering concept in the sense that would have factories operating 24 hours a day and people working 8 hours a week. How much could you produce if you did that? That's the engineering concept. If we were to do that, of course, there would be massive pressure on resource costs and a lot of inflation. So the potential GDP concept I'm using is really a sustainable measure of GDP growth. And I think of it really as the speed limit for the economy once it has reached full employment. So right now, of course, we're not at full employment. Actual GDP is well below potential. So I hope we're looking forward to several years of growth above the potential rate to get us back to full employment. But once we get to that point, potential GDP is basically the governor that says how fast the economy can grow. So the Congressional Budget Office measures potential GDP in 3 steps. The first step goes back to the discussion of output per hour that we just had. They try to measure the trend growth in output per hour in non-farm business. The second step is that they add in their estimate of how fast hours growth can be to get a measure of output, potential output in non-farm business. And then finally, they convert that to be a measure of potential for the entire economy. Because non-farm business is only about 2/3 of the economy. We also have the government, housing, nonprofit institutions, all of which tend to grow more slowly than non-farm business. So there needs to be a conversion to get to an entire economy number. So what do their results show? So this bar chart shows CBO's estimate of potential output growth for each decade from the 50s up through the first 12 years of the 2000s. And then the last bar is their forecast for the next 10 years. And what you can see is this gradual downward move. The bars get to be shorter and shorter. And so in the 50s and 60s, CBO was estimating that the economy could grow at about 4% per year. By the 80s and 90s, it was down to about 3%. Over the last 12 years, it was a little under 2.5%, and they forecast pretty much the same going forward, 2.25%. So the reason that we have this downward movement is partly that they have a subpar view of productivity growth in the future. But it's mostly about hours, and it's mostly about demographics in their forecast. And that is that the labor force is likely to grow slowly going forward because we have the retirement that's already started and will continue of the baby boom generation, as well as the fact that we no longer have women entering the workforce as rapidly as they did before. So let me conclude. So on productivity growth, it's been anemic since 2004, and I think IT has been a major factor behind the anemic growth. Analysts, including myself, expect a modest pickup, but not enough that will get us back to the long-run average of 2.25%. So we're looking, I think, at a period most likely of relatively slow, subpar productivity growth for a while to come, subject to, of course, the risk that these things are hard to predict. Translating that into potential GDP growth, the expectation is that the U.S. may grow at about 2 to 2.5% per year, which is historically slow, but is largely a reflection of the fact that we don't have a rapidly growing labor force anymore. I should just conclude, though, with a final thought, and that is that all of this sounds very deterministic, but it's not at all set in stone. I've alluded to the possibility that we could get a second wave of IT that would boost growth. I think that is a real possibility. We'll just have to wait and see if it materializes. And the second is that we can implement smarter policies, smarter government policies that would help us grow faster, would ensure a somewhat brighter future. And by those sensible policies, I'm referring to doing what we can to improve the quality of education, to enhance the amount of legal immigration that we have to bring people with skills to the United States, to deal with our decaying infrastructure, and to have strong support for basic science. If we do all those things, our future will be brighter. But overall, I think we are going to be a relatively slow growth economy for a while to come. Thank you.